Fed Chair Powell says he's not going to lower rates for 2 years. Who cares, right?
Right.
The lie is that gold, it doesn't pay any interest. Who cares? So if the interest rates are staying up high on this crap that is truly crap, right? Big deal. 1 trillion times 0 is 0. And it really is just that simple. So that's really what I'm waiting for. Wall Street's job is not to push the price of gold. It's amazing that it's not still down at $600 an ounce or even $20 an ounce, because they can create as much gold that does not nor ever will exist as they want to. That part's easy peasy.
Gold prices rose on Friday after a slightly weaker than expected U.S. jobs report pushed the dollar and Treasury yields lower, offering some respite to bullion, which was still on track for its worst week in 6. The probability that the Fed will leave rates unchanged at its September 19th and 20 meeting is now around 85%, up from about 78% just before the data came out. Lynette Zang, the founder of IT Trading, believes the actual value of gold is often misunderstood because it doesn't pay interest. According to Lynette, gold holds significance for various reasons, such as its historical importance and rarity. She emphasizes that its inherent value remains intact, whether interest rates are high or not for gold. In a recent interview, Lynette highlights that the actual value of gold and silver is not determined on Wall Street, where prices can be unfairly controlled. Instead, it becomes most significant when central banks take action in response to unstable currency situations. These banks are accumulating more gold because they understand what's happening and want to control the financial crisis. Central banks bought a staggering $70 billion of gold in 2022, the most since 1950, as heightened macroeconomic and geopolitical uncertainty drove governments to accumulate the precious metal. Central banks buy the world's favorite haven because it retains value against volatile currencies or falling bond prices. In Lynette's view, it's wise to follow the lead of these central banks because they possess the most knowledge about how money works and how economies function. Despite some people claiming that gold's future is uncertain due to central banks' interventions, Lynette believes that holding gold helps protect her wealth from potential economic uncertainties, which are part of the ever-changing financial landscape. Now, watch excerpts from Lynette Zang's interview with Ron's Basement. Make sure to watch the entire video and consider subscribing to our channel. Don't forget to enable post notifications to stay updated on our latest uploads. Thank you and enjoy the video.
Let's kind of look at that for a minute, because that's not ever the way that I think about gold and silver, because this is insurance, but it's also a strategy. And let's say that tomorrow spot gold goes to $6,000 an ounce. Are you going to sell your gold? And what if silver goes to $900 an ounce? Are you going to sell your silver? So I'm not looking for the market change of sentiment as far as the nominal price of gold and silver are concerned. What I'm looking at is what the central banks are doing, because at the end of the day, when all confidence is lost in the currency, in the powers that be, and that's my fondest wish, that's really what my battle is. When all that confidence is lost and they're trying to regain that confidence, then they do those overnight revaluations where they take this garbage that is only used in one area and they revalue it in this area that is in gold and silver too, that are used in every single sector of the global economy. In Venezuela, that happens to be the one that I can remember the easiest. Don't ask me why, because it's happened so many times. But the first overnight revaluation they did, spot gold in Venezuelan bolivars went up 3,500%. Did it express to its full fundamental value? No, not yet. But that's, for me, what I'm waiting for. Because what happens is it gives you an opportunity to pay off any fixed rate debt that you have with dollars that have zero value, right? It gives you an opportunity to buy those now undervalued assets that we know are most likely to make it because they've made it that far, right? It's really hard looking at the balance sheet, since so many things are done off balance sheet, to know whether or not a company is actually really solvent, because there's just so many ways that you can juggle that accounting. So that's it. It isn't in the spot market. That's Wall Street's market. And JP Morgan Chase and other bullion banks and other traders are tasked with suppressing it. It's when the central banks, who have been loading up on more gold than they ever have before, because they know what's happening, they want to keep their choices, they want to stay in control, right? They're loading up on gold right now. Let's see. Who knows more about money than central bankers? Why wouldn't you just do what they're doing and doing for themselves? Because it's interesting. There was just a little headline that came out how gold is directionless. They don't say spot gold. They say gold is directionless because Fed Chair Powell says he's not going to lower rates for 2 years.
According to Lynette, there's a problem with constant money printing through quantitative easing, QE. The QE iterations have been less effective over time, leading to a challenging situation where it's becoming harder for individuals, corporations, and governments to refinance their debt. Even though central banks claim to be tightening their policies, interest rates are still relatively low compared to real inflation rates, indicating that money is still manageable. Lynette expresses concern about central bank digital currencies, CBDCs. She believes that if CBDCs become a reality, policymakers will have constant control over the economy and receive instant feedback on their decisions. This alarms her because it means policymakers could make real-time changes to economic policies, which could have significant economic consequences. Let's get back to the interview.
But here's the problem, and you can see it. When they first came out with the quantitative easing, so money for free, all of this money printing, every iteration afterwards took a lot more money and they were getting a lot less result. And they have been on this quantitative easing, and even now, they call it quantitative tightening, but globally money is still extremely loose. Whenever you have interest rates that are below the real rate of inflation, that's easy money. I don't care if you had interest rates at 20%, right? If the rate of inflation is at 30%, that's still easy money. So, for them to talk about tightening is kind of garbage, but it is becoming more and more challenging for people to roll, or corporations or governments or whatever, to roll over that debt. So in some ways there's easing, and some ways there's tightening. Just like, look at the Bank of Japan, right? They lost control of their yield curve control, but I've done pieces on that historically as they've been going along. So it's pretty obvious that they were losing control. But rather than making it obvious to the public, what did they do? They broadened their band. They did that on Friday, and on Monday they announced a major bond buying program. I mean, those are just the opposite. So what does that tell us? Because Bank of Japan is really the leader in the world of all of these experiments, these monetary experiments. And that started back in the early 90s. And, they're the ones that created the zombie firms. So, and this yield curve control. Okay, so you print a whole bunch of money and you go in and you buy a whole bunch of bonds to control the price. And all that really does is convolute interest rates out there, the value of the money, the price of the money. So, when I see that on Friday they did loosening, and on Monday they did tightening, because what happened, boy, shocker, interest rates exploded on their 10-year JGB, of which they own most of that anyway. It tells me that we are closer and closer and closer to the end of this experiment. And I think what we just saw with the Bank of Japan is the canary in the coal mine. And I'm paying a lot of attention because it ain't over yet. Just like the bank eruption that we had in March. But do you think all those issues, those underwater investments went away? Do you think they're not at Bank of America and, God forbid, JP Morgan and every other bank on the planet? Of course they are. They're just being hidden. The problem is that we haven't really felt the full effect. I mean, the economy has not yet felt the full effect of that rapid rise in interest rates because of the lag effect. So this is the good thing about CBDCs, and especially when you read what they say, because they will have their finger on that button 24/7, and they will get instant response if their policy choices are working. That, I don't know about you, but that scares the Hades out of me.
Gold is expected to retain its value despite its price fluctuations. The fact that central banks are purchasing significant amounts of gold indicates their belief in its potential to protect volatile currencies and economic uncertainties. What are your thoughts on Lynette Zang's perspective about gold and its actual value? Please share your thoughts in the comments section below. If you found this video informative, remember to give it a thumbs up, subscribe to our channel, and enable notifications to stay informed about our latest videos on silver, gold, and copper. Thank you for watching, and we appreciate your support.